Everything you need to know about home loan. This is my home loan closing disclosure document that I have taken in year 2020. I had to sign this document to get this loan. I still have this loan. I'll be using these documents to explain all details about home loan. This is very easy to understand. There is no complication at all. So our first portion of the video, I'll talk about how to calculate your monthly payment. Also, the last page of the document, this is a 6-page document. For my case, it could be a little bit more or less for you. So this is the APR, annual percentage rate. So I'll be showing all of this calculation right before you sign. This is the last page summary information. So in the first few minutes, I'll be explaining how to basically calculate this number, and then as I calculate those, I'll be discussing about these different kinds of fees that goes in those dollars to add up to your total payment and things like that. Finally, I'll be talking about how to save money by paying early. Just in making a very small payment per month, you can actually save a lot of money over the course of the loan. Home loan is for a very long time. So many things changes. People usually pay off earlier. So I'll be showing you detail on that calculation of how you can actually save more money by paying a little bit earlier. So I have copied all this data in Microsoft Excel. First thing, I'm going to be showing you how to calculate your payment. Excel has a very simple function called PMT that will give your payment. So it will ask for your rate. This is the rate, and it is 12 months rate, yearly rate. Home loans are monthly compounding, so you divide by 12, so that gives us the monthly rate, comma, this was a 15-year loan, so that has 180 months, 15 times 12, comma, then the present value of the loan, the money I got from the bank, was $220,000. That says you're going to pay off that, and you can set future value 0, you're going to pay off everything. Don't really have to worry about the type. Hit enter. So this is same as what the loan closing disclosure says your monthly payment would be. The next thing I'll be calculating is called APR. The home loan has lots of fees. So what you pay is not the rate they show in the first page of the document, which is 2.375%. That's not what you pay. So to calculate APR, when you use the rate function, it will ask for the number of period, which is 180, comma. It will also ask for your monthly payment, comma. In the present value, you don't select that 220,000 because that's not what you got in your pocket. What you got in your pocket is $216,578, not 220. It is shown the last page of the document what you got in your pocket. So this is what you got in your pocket. However, you got a little less in your pocket, and you are making a basically more APR. Now, if you leave everything as it is, one important note, the number in Excel, if it's red mark within parentheses, those are usually negative, and then these black stuffs are positive. So this red function to work, one of the numbers must be positive, one must be negative. So this is per month. Now you have to multiply by 12. That's going to give you this APR, the exact same as what we have got in the loan closing document. The next thing we're going to calculate is the total payment, total principal and interest. So how much we paid, principal and interest. So that will be simply, this is the monthly payment I'm making. In that monthly payment, I paid some interest and some principal times 180 payments. So that is my total principal and interest. Then I'm going to be calculating the interest now. So that would be simply, this is what I'm paying, but this is actually, I owe to the bank. So this is the total interest. So now I'm going to calculate the fees. That would be, you see in the loan closing document that says I'm going to be paying $45,145.86 total finance charges. That include the interest and the fees. So then simply you can this minus this, the red mark parenthesis already minus, so you really don't have to minus that. Simply just plus that, select that. So this is my total fees that was associated with the loan. You can calculate these fees in another way too. So you can simply do this. So this is the bank says you're going to pay off, and this is what you got in your pocket. So this should be the exact same. So this is the total fees actually I paid to the bank. One of the thing I would like to call that is a difference. Let me show you what I'm talking about. So if you see this plus the fee, well, this is a minus number, so I'm gonna do minus sign here so that I'm adding these two number. So look, this number is not adding up to this number. So I'm gonna say here the principal plus interest plus fee in there. So there was some difference. I'm gonna name this as difference. So let's see how much was the difference, this plus this guy. So about $1,404 was paid to the bank in the process. We'll be explaining that soon. Let me show you how to calculate the total interest percent. Then we move on to the next section of the video to explain a little bit on that. So this is total interest percent TIP. So TIP is simply how much interest you pay divide by, I'm going to use a minus signs to make this negative interest rate market stuff, divide by the total, actually this plus the difference. That was actually the total. Oh, it's wrong. It's the same thing basically. I don't know why Excel gave me the red for. Oh, not that. I want to do this format like that. So you see that TIP is exact same as what was in the loan. So this is basically all the calculation, all the numbers in the last page of the loan. So second part, I'll be discussing about the fees associated with this loan. Let me show you what I'm talking about. So the first page is the kind of the interest rate. So loan cost, this is the fee that actually collected by the bank. So this $453.23 goes to the bank. So this is the pure fee from the bank. Some other fee are required by the bank, which is kind of redundant. Every time you buy a house or sell a house, they will do for license, flood insurance, stuff like that. So this is part, this money goes to the bank because of this loan. They want to make sure the house is in good condition. The other cost part, that does not go to your bank. So this is the insurance, city taxes. Where you live, they provide utilities, roads, schools. So you have to pay city taxes, government fees. Those goes under this other cost. Only one item, which is the prepaid interest, that goes to the bank. So let me explain what prepaid interest is. So when you go to buy a home, you have to have money first in your pocket. Then you can go to a seller, say, hey, I want to buy your house. I can pay this much. Can you give me the house? So your loan must be approved first before you actually sign the contract to get a house. And there is always some days in between that. In this case, there was 26 days. So the loan was approved on July 6th. Actual payment was made was August 1st. So you have to pay this prepaid interest. So the money in your bank already, in your bank account for 26 days. So bank will collect that. So that is called prepaid interest. So that is simply per day interest. This yearly rate divided by 365 times 26 days sitting in my account is $220,000, which is the exact same as what we have seen in the loan closing document. That prepaid interest also goes to your bank. So they will charge that because you got that money already in your pocket. So they will charge that interest. So one of the number we didn't show how the bank is adding up, which is the total payment. So now we can show you how to add the total payment. So the total payment in your last page of your documents includes the total principal and interest plus the loan closing cost, which was, let me copy that here. So I'm gonna bring that from the document. So closing cost. I thought I copied that, but let's copy it again. So this is the loan cost that goes to the bank. The other cost does not goes to the bank except the prepaid interest. So this is the loan cost, not the other costs. I'm going to say actually loan cost instead of closing cost because closing cost actually include everything. So the total payment will be simply this plus the loan cost plus the prepaid interest plus this principal and interest. Now, this is a negative number, so I'm going to do is I'm going to use a negative sign so that becomes a positive number. As you can see, this is exactly same as what's the loan closing document say at the end that the total payment would be. So that $266,550 is the total payment. And we go to the last page of the document. So this is what that number is simply. So this includes simply the loan cost, prepaid interest, and the principal and the interest of that. So now we're gonna do is I'm gonna create a amortization schedule to show you how much you can actually save over the course of the loan if you, let's say, make an additional monthly payment. So I'm gonna copy that. Or if you make a lump sum payment, home loans are for a very long time. There's so many things changes along the way. So we can show you how to actually calculate all those stuff. So what I'm gonna do first, we already calculated the payment. I probably can do it again. PMT rate is this divided by 12, comma, 180 payments, comma, the present value. That's it. That's the payment. So to calculate the amount of saving, first thing you need to create is this thing called the amortization schedule. That will give you detail about what happens to the loan every year to year. So I'm gonna create some months here. I will use something called this sequence function and select this 180. So that will create 180 rows for me, 180. And then I will say loan here. So I have for the first month 220,000 loan, entire money. I didn't pay anything from. So when I make the payment of this guy, I'm gonna freeze that, typing a $sign before and after. So that freezes it because I will copy that all the way down. And then out of that principal payment, I have paid some interest. So the interest amount would be simply, this is the loan amount times the monthly rate. So I hold that money for 1 month. So monthly rate would be this divided by 12. So this is, I'm going to make it negative. So I'll think about money going away from my pocket is negative. Money coming in my pocket is positive. So principal. So now I made 1,454. And out of that, 435 was my interest. So rest of the money goes towards my paying my that 220,000. In the next month, I will have less than that principal amount, which is a negative sign. So I'm not going to use another negative there. So it's going to automatically subtract everything. So basically I copy everything down like that. So I think I made a mess somewhere. This should be freezed. I'm using that again and again. This should fix everything. All right. Now, one of the check you must do after you create the loan amortization schedule is that check of that principal value. So if you simply type sum all the principal, that should sum up to $220,000. That tells you that yes, this loan has been completely paid off. So this number should add up to that. You can go all the way to the down to check what's going on. So in your last month, if you extend that one more row, you will see there will be nothing left for your principal to pay. So that means this amortization schedule is correctly done. This is where you can see what is happening every month after month. So next, what I'm going to show you is, so let's calculate the total interest paid. So interest paid, you can simply sum the interest column, which is this one. This should be exact same as what we have calculated in the previous. So the total principal plus interest, that should be simply, you can do simply this monthly payment times 180. That will be exact same as this number we have calculated in the previous calculations as well. So these numbers are exact same as what we have calculated here. So this completes the loan amortization schedule. Now, say the question is, let's say we start to make payment extra $500 per month starting from, say, next year or so. We paid for 1 year and then starting from next year. So I'm going to copy this entire amortization page to a new page. And then this I will say is just simply, let's say 500 monthly starting from payment 13. So we can add 500. Let's say we got a raise, we can afford to pay a little bit more. We're going to go all the way. So you can see here, this is now adding up to that 220,000. So there was something wrong there. We actually paid significantly earlier. So we're going to go all the way down to figure out where. So this is where this thing is started to get negative. So I'm not going to owe anything to the bank. So for the last month, you see I only owe $821.26. So this, I have to manually adjust this last month payment. I don't owe $1,954, so I don't need to pay this much. I need to only pay this plus the interest on that. So that would be my monthly payment. Now what I'm going to do, I'm going to make it part negative so that the sign is consistent, and this adds up to $220,000. So as you can see that instead of paying in 180 months, you're paying this loan significantly early at 132 months, and the last month payment would be this. Another scenario would be, I'm going to copy this, that you pay some lump sum money. Let's say you got some $20,000 or $30,000, then next year from something, then you're going to pay that just one time, $20,000, for example. And then how quickly, how soon you're going to be actually paying off the loan if you make an one-time additional payment. You can simply delete this, adjust that last month payment. So this is going to be adjusted to simply this plus the interest on that. And I'm going to make this negative to be in consistent sign. So this should add up to 220 right here, which is does. So that means calculation is correct. Now, one of the things I want to show you, now this loan was, say, at a time where interest rate was very, very low. So what if this is current interest rate? It's almost 7% now. As you can see, there was a significant amount of saving, and thing changes if the rate is at 7%. So I'm going to change this to 7% and see how much you'll be actually saving by paying at the current mortgage. Let's say you're taking a mortgage right now. So the total saving would be the interest paid in if you pay additional minus the interest paid on the original loan, like that. As you can see, $38,000, almost $39,000 saving from this particular if you pay $500 extra per month. So that completes that everything I wanted to discuss here on this home closing or understanding home loan. I hope this helps. Thank you for watching this very long video.